Imagine a single sentence wiping tens of billions of pounds off the crypto market in under an hour. It happens more often than you might think. When the United States approved the first spot Bitcoin exchange-traded funds in January 2024, more than $4.5 billion changed hands on the very first trading day. And when a regulator hints at a crackdown, or an exchange freezes withdrawals, prices can fall 15 or 20% before most people have even read the headline. Crypto markets run 24 hours a day, 7 days a week, with no closing bell to pause the panic or the euphoria. In this video we'll break down exactly how news shapes crypto prices, which stories actually matter, and how to tell genuine market-moving information from the endless noise that floods your feed every single day. To understand the impact of news, you first have to understand why crypto is so uniquely sensitive to it. Traditional stock markets close overnight and at weekends, giving traders time to digest information. Crypto never sleeps. A piece of news breaking at 3 in the morning in London is instantly traded in Singapore, New York, and Sao Paulo. On top of that, a large share of the market is driven by retail investors and automated trading bots that react to keywords in seconds. There's also far less of what economists call liquidity, meaning fewer large buyers and sellers to absorb shocks. So when news hits, the same headline that nudges a blue chip share by 1% can swing a cryptocurrency by 10. This combination of constant trading, emotional participants and thin order books makes crypto the most news-reactive asset class on the planet. If there is one category of news that moves crypto more than any other, it is regulation. Governments deciding whether to embrace, tax, restrict or ban digital assets can reshape the entire market overnight. The approval of spot Bitcoin and Ethereum ETFs in the United States opened the door for pension funds and wealth managers to allocate capital that had previously been off-limits. In Europe, the Markets in Crypto-Assets framework, known as MiCA, became fully applicable at the end of 2024, giving the whole bloc a single rulebook for the first time. Here in the United Kingdom, the Financial Conduct Authority has steadily tightened its stance on how crypto can be marketed to ordinary investors. Each of these developments rewires investor confidence. When clarity arrives, capital flows in. When uncertainty or restriction looms, it flows straight back out. Since those spot ETFs launched, a brand new data point has become a daily obsession for analysts: fund flows. Every trading day, issuers like BlackRock, Fidelity, and others report how much money flowed into or out of their Bitcoin and Ethereum funds. A run of strong inflows, sometimes hundreds of millions of dollars in a single day, signals that institutional demand is healthy and tends to push prices up. A stretch of outflows can foreshadow weakness. What makes this so powerful is that, unlike a rumor or an opinion, ETF flow data is hard and verifiable. Professional traders now watch it the way equity traders watch corporate earnings. For ordinary investors, learning to read these flow figures is one of the most reliable ways to gauge whether the so-called smart money is buying or quietly heading for the exit. Crypto likes to present itself as independent from the traditional economy, but the data tells a different story. Bitcoin and the wider market are heavily influenced by macroeconomic news, especially decisions from central banks. When interest rates are high, riskier assets like crypto become less attractive, because investors can earn a safe return elsewhere. When rates fall, money tends to chase higher returns, and crypto often benefits. That's why a single inflation report from the United States, or a rate announcement from the Federal Reserve, the European Central Bank or the Bank of England, can send Bitcoin moving sharply within minutes. The US dollar's strength matters too, since most crypto is priced against it. Understanding this macro backdrop is essential, because no amount of positive crypto-specific news can fully fight against a hostile economic tide. One of the great advantages of crypto over traditional markets is transparency. Every transaction is recorded on a public blockchain, and analysts mine this for clues the way meteorologists read a weather system. They track how many coins are sitting on exchanges, because a large outflow often suggests holders are moving funds into cold storage to hold long-term, reducing selling pressure. They watch wallet activity from so-called whales, the largest holders, whose movements can precede big price swings. They monitor metrics like realized profit and loss to judge whether the market is fearful or greedy. This on-chain analysis turns the blockchain into a real-time dashboard of investor behavior. Combined with news, it helps separate a temporary panic from a genuine shift in the market's foundations. Few stories hit harder than bad news from a major exchange. The collapse of FTX in November 2022 erased an empire once valued at $32 billion in a matter of days, and dragged the entire market down with it. That event taught millions of investors a brutal lesson about counterparty risk, the danger that the company holding your coins might fail. Today, news about an exchange's financial health, its reserves, a security breach or a regulatory action can trigger immediate sell-offs. This is why the phrase "not your keys, not your coins" became a rallying cry. Whenever you see headlines questioning an exchange's solvency or a sudden pause on withdrawals, treat it as a serious signal. The market has a long memory, and trust, once broken, is extraordinarily difficult to rebuild. Here's the uncomfortable truth: a huge share of crypto news is noise designed to provoke a reaction, not to inform. Social media is full of anonymous accounts, paid promotions, and outright manipulation. A common trap is the pump and dump, where insiders hype a small coin to lure buyers, then sell into the rush. To protect yourself, learn to ask 3 questions of any headline. First, is the source credible and verifiable, or just an anonymous post? Second, is this genuinely new information, or old news being recycled to stir emotion? Third, who benefits if you act on it? Genuine market-moving news, like a regulatory ruling or a confirmed ETF flow, comes from primary sources and can be checked. Rumors and hype cannot. Building this filter is the single most valuable skill in navigating crypto markets. Markets are ultimately driven by human emotion, and crypto amplifies this more than most. A popular tool called the Fear and Greed Index condenses market sentiment into a single number from 0 to 100. Extreme fear, near 0, often marks the moment when prices have fallen so far that brave buyers step in. Extreme greed, near 100, frequently signals a market that has run too hot and may be due for a correction. The legendary investor Warren Buffett's advice to be fearful when others are greedy, and greedy when others are fearful, applies remarkably well here. News doesn't just deliver facts, it shapes mood. A scary headline can create a buying opportunity, while relentlessly positive coverage can be a warning that euphoria has peaked. Knowing that news matters is one thing, acting on it sensibly is another. The professionals don't react to every headline. Instead, they build a disciplined routine. Start by identifying a handful of trusted primary sources, official regulator statements, established financial outlets, and verified data providers for ETF flows and on-chain metrics. Set a fixed time each day to review them rather than refreshing your phone every 5 minutes, which only feeds anxiety and impulsive trades. Keep a simple journal of major news events and how the market actually responded, so you learn the real patterns rather than the imagined ones. Above all, decide your strategy before the news hits, not in the heat of a crash. A plan made calmly will always beat a decision made in panic. So let's bring it all together. Crypto is the most news-sensitive market in the world because it never closes, it's emotionally charged, and it moves on thin liquidity. The stories that genuinely matter fall into clear categories: regulation, institutional flows through ETFs, central bank policy, on-chain behavior, and the health of major exchanges. Everything else is largely noise. As we move through 2026, with regulatory frameworks like MiCA now bedded in and institutional money a permanent feature of the landscape, the market is maturing, but it remains fiercely volatile. Your edge isn't predicting the next headline, it's knowing how to interpret it calmly when it arrives. Master that filter between signal and noise, respect the macro tide, and never trade on emotion. If this analysis helped sharpen your thinking, stay tuned for more, and look after your capital out there.